Hi, everyone. Thank you so much for tuning in today. Just so you know, I hope everyone's having a great week so far. And then, so as we're kind of waiting for everyone to settle in, I have a question for the audience. So what challenges have you encountered so far with either planning for, transitioning into, or living in retirement? And then you can use that question section of your GoToWebinar control panel to answer. And then feel free to let us know where you're tuning in from as well. And then I know a challenge that I've kind of experienced pretty recently is, making sure that I'm truly diversified in my Roth IRA. So I've been taking a lot of time, kind of looking over all of the ETFs or index funds that are in there, especially when I'm relying on them. So I always want to make sure I'm diversified. So that's one of the challenges that I'm trying to navigate. Charles, what types of challenges have you kind of faced so far while investing for retirement?
I think the one lesson that took me a little while to learn was just the importance of automating, particularly making sure that your retirement savings come right out of your paycheck, so they don't hit your checking account. You never get a chance to spend them. I realized after I learned that trick and just have money go right out of my checking account, that made me a much better saver because it just took away any ability I had to actually spend it on something probably frivolous, but certainly fun in the moment.
Yeah, that's good advice. All right, well, I think everybody's kind of getting settled. Feel free to continue answering. We'd love to hear all of the different answers coming in. But I know it's 1:05, so I want to get started. I appreciate everyone's time, and I want to be cognizant of that. So hello, and welcome to this afternoon's webinar, A Data-Driven Approach to Retirement Planning, led by Craig Israelsen and Cynthia McLaughlin. Thank you so much for joining us. We're happy to have you all here. So my name is Jennifer Shear, and I'll be your host for today. And then, we have a really great group joining us today, along with our special guest, Craig. And I've been looking forward to this webinar. I'm really confident that you'll find it valuable. And we have some really fantastic topics to cover today. And then as a thank you for attending today's event, we are offering all attendees a special discount on the Retirement Portfolio Analyzer, also known as RPA, as well as AAII Retirement Investing. So please stay tuned for after our presentation. And then, but before we begin, there are a few things that I like to go over. So first off, I want to remind all of our webinar viewers that AAII is a nonprofit educational group and is not a financial advisor, and thus is not able to give any personal advice. So every investor is different. That's kind of why our goal with each broadcast and our articles is to educate you on how to make better financial decisions. And then please keep an eye on your chat section throughout the webinar. I'll be posting helpful resources, key information, and of course, our special offers. And then any kind of contact information or special links, I'll throw those in as well. And then if you have any questions for our speakers during the presentation, you can submit them using the question section of your GoToWebinar control panel, which is located on the right-hand side of your screen anytime during the presentation. And then once our presentation concludes, I'll select a few, actually Charles will select a few for Craig and Cynthia to answer. And then if your question isn't selected during the broadcast, feel free to email us at members@aaii.com. And then you may see a few different documents in the handout section of your GoToWebinar control panel, also located on the right-hand side of your screen. And so we've included Craig's presentation slides as well as Cynthia's. And then these handouts are for you to follow along with, and then also will be emailed to all attendees afterwards. And then if you experience any issues with the audio or the video of the webinar, please consult the GoToWebinar website for support at gotowebinar.com. And then just a friendly reminder, I'll reiterate this later in the presentation, but it is recorded and a replay of the webinar will be sent to all who attended today. And then the PDFs, handouts, resources, and recording will also be accessible at aaii.com/webinars. And then for new viewers, we always like to give a little background about our organization. So the American Association of Individual Investors is an independent nonprofit corporation formed in 1978 for the purpose of assisting individuals in becoming effective managers of their own assets through programs of education, information, and research. And with that, I'd like to hand over the presentation to Charles to introduce our two speakers.
Thanks everyone for attending. We appreciate it. I hope you all have sunnier weather than the clouds we have here in Illinois today, but that's springtime. But we have two great speakers, as Jenna said, Craig and Cindy, and I'm going to keep my comments very short and turn it over to Craig, who has some great presentation and great insights into retirement.
Charles and Jenna, thank you. I really appreciate that. I enjoy working with these good folks and appreciate the effort they put in consistently, not just today, but every day. So I've titled this, and thank all of you for taking just a moment out of your day. We'll try to make it worthwhile. So I've titled this Test Drive Your Retirement Portfolio. And as I am turning 66 this year, this is something that I think about more at a very personal level. So with that, let's get started. A couple of questions that are not uncommon to ask. Will my portfolio balance decline during retirement? Fair question. And will I run out of money in retirement? In other words, decline is one thing, get gutted is another. And I want to address both of those. So these two questions were answered using the Retirement Portfolio Analyzer, or RPA, using historical performance data over the past 99 years. So 1926 is a really common start point because that's when we have valid annual return data for the S&P 500. And we have some other indexes that can simulate small stock and bonds and cash. So there's 4 asset classes: large US stock, small US stock, US bonds, and US cash, that we can go back almost a century. So the RPA is an Excel-based tool that allows us to enter a number of variables that are specific to us, to each individual. This is a spreadsheet that I've been working on for over 10 years, and it has a lot of really cool functionality that allows us to, like I said, test drive our approach to retirement. So in the bright yellow cells are some of the variables that we control as we use the RPA. The balance of the portfolio, and this is showing $1 million. It can be whatever. Our current age, the age at which our withdrawals begin. And then our allocation. What's our allocation to large stock, small stock, bonds, and cash? What's the cost of our portfolio? What's the collective cost of the mutual funds and ETFs? If there's an advisor, how much does he or she overlay? And then how we're taking the money out. Right now, this is showing RMD. So if you type in RMD, the software automatically goes to the RMD table and applies those escalating percentages. And then in that portion now highlighted with the pink circle, we get some information about the average withdrawal per year. And then how often do those withdrawals increase? How often do those withdrawals keep up with inflation? Then we have in the blue, what was our average ending balance after 25 years? How often did the balance grow from the starting balance, in this case of $1 million? How often did the portfolio survive? Meaning, did it ever completely get depleted? So that's some of the basic information that immediately is available to us as we refine these individual variables that pertain to you or to me. So how does that actually work? This is not Monte Carlo. This is not simulation. This is actual historical results of very well-known indexes. So here's the best way to think of it. From 1926 to 2024, there have been 75 rolling 25-year periods. And 25-year period is a pretty good simulation, or a pretty good, shouldn't use the word simulation, a pretty good estimate of how long we will be withdrawing money. That takes us from age 70 all the way to age 95. Most people, their withdrawal period will exist within that 25-year window. So the first 25-year period was 1926 to 1950, the second from 27 to 51, and so on. So let's assume that each of these 25-year periods represents a window for 75 different retirees. And in this case, running from the age of 73 to 98. And I chose 73 because that's when RMD begins, but it can be any 25-year span from age 60 to 85. It doesn't matter. It's just 73 is kind of a normative beginning, just based on the requirements of the required minimum distribution. And we're also assuming that each retiree annually withdraws money. Okay. So what we're really doing is we're analyzing sequence of returns risk, because we're analyzing outcomes over 75 different 25-year periods. You drop off a year, add a year, drop off a year, add a year, and you think, well, that's not really going to cause much change, but it really does, and as you'll see in just a minute. So, first question: how often was a 60% equity, 40% fixed income retirement portfolio larger at age 98 than it was at age 73? And in this analysis right here, I'm assuming a portfolio cost of 125 basis points, which may horrify some of you. And if your portfolio cost is less than that, then the results will likely be even better. But it just shows 125 as a starting point. The answer, historically speaking, looking over the last 99 years at 75 rolling 25-year periods, if the RMD is governing the annual withdrawal, the portfolio was still larger than its starting balance 81.3% of the time. If, on the other hand, you're taking 4% out each year, 4% of the balance, the portfolio was larger after 25 years of withdrawals than its starting balance in every rolling 25-year period, all 75 of them, 100% of the time. So remember that first question: will my portfolio balance grow during retirement? The answer is yeah. In most cases, it does. Now, if you're taking out 13% a year, no, it's not going to grow. We have to be reasonable in our withdrawals. So let's take a look at this in kind of a matrix. So here's that 60-40 portfolio. Here's an RMD method of withdrawing. There's that 81.3% of the time. And we're answering, this percentage relates to how often was the balance larger than the starting balance after 25 years. There's the 100% associated with the 4% withdrawal rate, a 5% withdrawal rate. The portfolio grew larger than the starting balance just under 95% of the time. Okay, but that's a 60-40 portfolio. What if we have a more conservative approach, a 40-60, so 25% large stock, 15% small, 45% in bonds, and 15% in cash? Well, in that case, the portfolio was larger than the starting balance only 42, call it 43% of the time if the RMD is governing withdrawals. A 4% withdrawal rate, wow, 98.7, so almost every time. A 5%, 90.7. Okay, what if we're on the other end of the spectrum, a little bit more aggressive in our asset allocation with an 80-20? If the RMD was governing each annual withdrawal, that portfolio was still larger than its starting balance 92% of the time. 100% at a 4% withdrawal rate, 100% of the time with a 5% withdrawal rate. Pretty encouraging, really encouraging results, I would say. So what's the first takeaway? It is, if the RMD governs your withdrawals and you hope/want your portfolio to grow over time, you'll need to have a larger equity allocation. That's probably not a shocking type of realization, but it's important that it's specific to the RMD. The RMD is a more challenging withdrawal mechanism because it's an escalating rate, whereas the 4% is just consistent 4% each year. Okay, point number two. If you are using a 4% or a 5% withdrawal rate and you want your portfolio to grow, the asset allocation is not as critical, meaning you can be more conservative without guilt. This isn't a competition. If you are most comfortable with the 40-60 in this example, little bit more fixed income, a little bit less equity, we still see really good results to the right of that little box. You're going to grow that portfolio almost every time. So really, really encouraging. And these point number 1 and point number 2, as you notice, these are specific to how money, the insights are specific to how money was being withdrawn. That becomes a really important variable. Now to the next question, how often was a portfolio totally depleted? This is an easy slide. This is an easy slide. Never. That's pretty straightforward. Never. It just doesn't happen. And why doesn't it happen? Because each of these withdrawal methods, the RMD, a 4% annual rate, a 5% annual rate, guess what? They're all percentage based. We have not analyzed yet a method of withdrawing which mandates a fixed dollar amount of withdrawal. That's a very different animal. So I just wanted to focus initially on percentage-based withdrawals, which is what these results are based on. So point number 3, we can stop worrying about running out of money. If the portfolio is prudently built, rebalanced annually, and our withdrawals are reasonable, we won't deplete the portfolio within 25 years. And frankly, as we go to the RPA and use it live here in a minute, when you see the balances, you're not likely going to deplete it within 35 years either. So what's the key? Well, the key is everything prudent construction, rebalanced annually, reasonable withdrawals. And the fourth that I could add is we got to stay with it. We can't bail out. If we're in a 60-40 portfolio, we stay in a 60-40 portfolio. All these results you're going to see are based on that premise that as a retiree at the age 73, we're still a long run investor. We're more susceptible to sequence of returns risk, absolutely. But we're still looking at a 15, 20, 25 year window in which we're interacting with this portfolio. That's a long term. So underlying everything I'm going to share today is the absolute necessity of being patient and being consistent in staying with the plan. If the plan is a 60-40, we stay with it. If it's an 80-20, we stay with it. So what that means is we need to think about, kind of begin with the end in mind. Start out with a portfolio that you would feel comfortable with staying in for 10 or 15 or 20 years. Now, having said that, that's what these results are based on. If you personally start out with a 60-40 and then you migrate after 10 years to a 55-45, that's obviously fine. I'm just giving you the underlying mechanics of how RPA operates. And then just real quick, the impact of controlling portfolio expenses. And this is kind of why I started out with 125 basis points. So if we go back to that 60-40, we're now asking this same question: how often was a retirement portfolio larger than the starting balance after 25 years of withdrawals? In this case, using RMD. So not analyzing 4%, not analyzing 5%, just assuming the RMD is the driver of how withdrawals are made. As you can see, if we transition from 125 basis points of portfolio cost down to 50, we go from an 81% success rate, so to speak, up to a 90.7. And that's a pretty material change. If we have a more conservative, we go from 43% of the time the portfolio grew to 2/3 of the time, 67%. Well, that's really material. If we have a more aggressive portfolio, 80-20, we go from 92% of the time at 125 basis points to call it 95%. Basically, well, you can see it for yourself. Lowering the cost of your portfolio is more important when the asset allocation is more conservative. That should be self-evident because a more conservative portfolio will have, in all likelihood, a lower return over time And so that expense ratio is a larger and larger percentage of a smaller return. So that's probably quite intuitive. The RPA, just so you know, is going to be available to you at a discounted price if you decide this is a tool that might be helpful for you to run a number of scenarios and different examples of how you want to do things, how you want to test drive your portfolio. And if you're interested, feel free to reach out to me, Craig at AAII.com. Now let's do it. Let's go to the portfolio. Let's take a look in kind of real time how this thing behaves. So, didn't mean to hit that. Let's close that window. So here is one of the more important tabs in the retirement portfolio analyzer. This is called the 4-asset portfolio tab. All these little doodads down here are called tabs, and there's a whole bunch of them, but I just want to focus on a couple of them today. So here's where information is added. So it's currently 2025. Let's stick with that. Let's go with a $1 million portfolio. Okay, so with what we have so far, that portfolio, $1 million starting balance with, and it's a 60-40. Let's just leave our age at 73 and 73 because we may choose the RMD option. So this is 40% large stock, 20% small stock, 30% bonds, 10% cash. Our average withdrawal over all of those rolling 25-year periods was $77,000. Isn't that interesting? Because we're withdrawing 4%. So 4% was our first withdrawal. And yet our average withdrawal is $77,000. And you're thinking, whoa, $77,000 is way more than 4% of $1 million. It is, but guess what? Your portfolio is not staying at $1 million, it's growing. And you can see the balances right down here in this blue graph. All those upward sloping lines, that's the portfolio balance for all 75 different people, all 75 different rolling 25-year returns over the last 99 years. And you can see that it's pretty encouraging. There's differences, obviously. That dark blue line with the dots, that's the ideal 25-year period from 1975 to 1999. 1975 to 1999, that was the sweet spot, the best 25-year period, because you didn't get impacted by the equity meltdowns of 1973 and 74, and your last withdrawal was right before the tech wreck of 2000, 2001, and 2002. And so by virtue of all the different ending points you see in this graph, this blue graph, that's a demonstration of what we call variation of outcomes based on different sequences of returns, or for short, sequence of returns risk. And it's illustrated in living color in that graph. The average ending balance for this portfolio is 2.9 million. That's the average ending balance after 25 years of withdrawals. It grew 100% of the time. It survived 100% of the time. 60% of the time, withdrawals kept up with inflation, and 63.7% of the time, the withdrawals increased year over year. Oh, now that's the one. That's the one that may bother some people, because you may say, well, I want it to increase 100% of the time. That's a different thought process. That's a different mechanism to interact with your retirement portfolio. Let me show you how that would play out. So let's say I entered a 0 there, and you saw when I did that. Let me just go back with a 4. So if it's 4%, or it could be 5%, or it could be 6%, or 7%. This cell right here, this cell C22, is a really important cell, because that's what a lot of analysis might hinge on, is how money is being taken out if you're satisfied with this asset allocation right here. Oh, and let's lower it down to 50 basis points. There we go. So let's type a 0. And then it allows us to say, okay, what would you like to have then as your first year withdrawal? And you type in, so let's type in $70,000. Okay. And I want a 3% COLA no matter what. So 3% in general, 3% even if the portfolio return is 0 or lower, meaning it had a negative return, I still want a 3% COLA. And I want a 3% COLA if the portfolio return is higher than 10%. Now, obviously there, if you're telling the software, listen, when I have a good year, a good portfolio return year, over 10% in this case, or let's type in 12%, I want a 4% COLA. So that lets you, dip a little deeper into the barrel after a good year. Okay, let's see what happened. All right, that's a pretty demanding scenario. You're starting out with basically a 7% withdrawal rate because 70,000 is 7% of a million. But then you're demanding to increase that by 3% each year. So what happens to the portfolio? Well, this graph over here, the blue graph, is very different. Now you have a number of these pathways heading down, meaning the balance is going down over time. In fact, the portfolio only grew 37% of the time, and it failed. Well, it didn't fail 61% of the time, but it failed basically 39% of the time. Okay, that's probably not acceptable. So we're going to have to change something. Do we change the asset allocation? Do we go to 100% stock? No. Our success rate is still only 60%. It's not about the asset allocation at that point. It's about too heavy of a withdrawal. That's what's driving these results. So let's go back to that 60-40. Let's go 40% for large stock, 20, 30, 10. And let's go to a $50,000 withdrawal. Whoa, things just got a lot better. So now we know that 70,000, if we're doing a cash-based withdrawal, that's much too heavy of a start. We drop it down to 50,000, which is still analogous to a 5% withdrawal rate in year one. Now we have a success rate of 90.7%. The balance grew 85% of the time. And let me show you something. If I click on this 4-asset print, here's the average withdrawals each year. So here's my average withdrawal in year one, and it's going to be pretty, it is what it is because we're forcing it, but it shows you the escalation of the withdrawals. If we go back to here and type in RMD, now we have the portfolio growing 91% of the time, 100% success rate. And now we look at these average withdrawals in each year of all of these rolling 25-year periods. What an impressive array that those withdrawals are just escalating, and yet it's not killing the portfolio because look here, say in year 5. In year 5, the average withdrawal was 54,000. The largest was 100,000, but the smallest was just under 19,000. That's what happens when we have a percentage withdrawal system, is that we can have some wide variation in the withdrawal in any given year. The average, of course, is the bulk. The results will be centered around that average, but we have these really, really dramatic outliers on the upside, and during the years like in the Depression, that 25-year period that started in the Depression, you're going to have an outcome in year 5 like that. Let me show you one more component that really becomes vital. What we were looking at, this is just your portfolio. This is that $1 million portfolio, or 750,000 or 500,000 or whatever it might be. But that's only one portion of your retirement income. And it's an important portion. But the budget tab allows us to now incorporate our Social Security benefits for both spouses, if there are two individuals, You would type in anything in bright yellow is what you enter. So if you think it's going to be a 3% COLA increase, you type that. And then the starting amount for each individual, any annuity income you might have, any other retirement income you might have. And then it shows you what is your estimated monthly withdrawal from the portfolio that you just designed on the previous tab. This information from this tab then feeds into this tab what that portfolio will contribute to your overall retirement income. And then because it's RMD, this column is allowing you to reinvest some of that if you don't need all of it. And right now it's programmed, but you can change it wherever you want. It's programmed to reinvest 25% of that withdrawal, 25% of 3,145. So then you have your estimated total monthly gross income from all sources, Social Security, annuity income, other retirement income, your portfolio withdrawal, minus any reinvestment you might do. There's that really important number, the estimated retirement income from all sources. How much of it is taxable? What's the tax rate? And now you get to the really good stuff. This is your estimated net retirement income per month. Then in bright yellow, you enter how much you'll be spending, your monthly retirement expenses. All of that rolls up together and feeds these last columns. And I know you're kind of getting a drink out of a fire hydrant here, but what we have ultimately is a cumulative estimate of your annual budget surpluses or deficits, plus the growing value or decline of your portfolio, plus the growth or decline of reinvested RMD, gets you to an estimated total accumulated capital each year of a 25-year retirement period. And as you can see, it's wonderfully escalating. So that number of 3.041, that becomes a key number because that's right here. If you go back to the main tab, and this number in pink, the estimated total accumulated capital after 25 years is $3 million, just over $3 million. And as it says, that's dependent on your specific budget data. That's probably enough of a review. The main thing I really wanted to drive home is that this tool, for me personally, has given me dramatically more confidence in the ability of a portfolio, no matter what its starting, let's say the starting balance is $100,000, so be it. That means the withdrawal is going to be smaller, obviously, and the ending balance is going to be smaller, but the success rate is still 100%. And so I don't have to worry about the portfolio dying. I might have to worry about if the withdrawals are adequate, but those are two separate issues. This has given me more confidence that I can take one worry kind of off the list and then redirect that energy somewhere more productive. But the ability to run through different scenarios, different assumptions. What if I went to all cash? Well, all cash, that's tough, as you can see. That's hard. That's just not a strong enough asset. And so for some people, this tool might nudge them to be a little bit more aggressive, if that's the right word, to have a little bit more diversification or a lot more diversification, like 25, 25, 25, 25. That's a 50-50 portfolio. And you can just tinker to your heart's content. And the longer you tinker, the more you will see if you're being reasonable in the withdrawals, you won't kill this portfolio. So with that, I think I've gone about 25 minutes, which was, I think, kind of the, oh, actually, I have a little bit more. Oh, that's wonderful. I was thinking 25, but I think I have about 30 or so. So let me Let me go to I want to show you the detailed for asset tab, because that one is really cool, because it gives you a dramatic visual sense of how much variation there can be in your experience versus the person next to you who retired a year after you, and then two people across from you that retired 2 years after you. So let's click on the detailed for asset. Okay, so this is dragging information from this main tab, this for asset portfolio tab that we've been working on. I'm going to go back and let's set this to, let's go back to $1 million just for the heck of it. Let's go to the detailed for asset. Okay, so there's that $1 million starting balance. We're 73, we're using RMD right down here, 50 basis points portfolio cost, and we have this 50-50 portfolio, 50% in stock, 50% in bonds. Now, this graph you're looking at, every blue bar is the ending balance of each individual person, and there are 75 different people. The first person started their retirement in 1926. That was their first withdrawal. Their last withdrawal was in 1950, and so forth. So you can see that all the blue bars are showing. That means no one ran out of money. If you can see a blue bar, you still have money in your portfolio. The green dot is the balance after 5 years, or in this case, at age 78. So let's look at that. So in some cases, the balance after 5 years, this case right here was just a bit over 2 million. And then the balance after 25 years was 1.8 million. Yeah, that was during the Depression. That was a rough start. But we see it here in more recent time frames, where the balance after 5 years is actually higher than the balance after 25 years. Excuse me, I felt that sneeze coming on. So one of the things I find very interesting in analysis like this is to think about how we as human beings really do this. I mean, we're looking at 25-year periods. Every blue bar is a 25-year period. We don't wait for 25 years to react to stuff. We tend to pull the trigger a lot sooner. So the question is, what do we know historically about the value of patience? And this is where I'm trying to quantify it. And I call it the Take 5 stat, the Take 5 statistic, which is the percentage of time that the ending balance after 5 years was higher than the starting balance. Okay, so you start your withdrawals. 5 years later, where are you at? Are you above water? Are you below water? Meaning, is your balance above what you started? Yeah, with this portfolio, 85% of the time, the balance was higher than it was 5 years ago. Okay, so now here's the really important one. It's the hang in there. So the hang in there statistic is, okay, what percentage of time was the ending balance after 25 years higher than the balance after the 5th year? In other words, if we get to the 5th year and we are, say, right here, we're below water. So what's water? Water is that kind of purplish little dash you see. That's the starting balance of $1 million right there. Okay, and that's the same for every person. So that purple dashed line is the starting balance. Well, in this case, the person who took out their first withdrawal in 1937, 5 years later, they had gone from $1 million to about 662,000. Okay, let's think about that. What are we going to do? We started with $1 million. We saw it go down to 662. Are we going to bail? Or are we going to chicken out? Or are we going to hang in there? Well, look at that one. See the blue bar? The blue bar finished above the green dot, meaning if you hung in there for 20 more years, 20 years past the 5th year, you actually saw an increased balance, and in fact, a balance that went over what you started with. That's why I call it hang in there. 68% of the time, if you'll hang in there, your balance will be higher after 25 years than it was after 5 years. Now, it's not guaranteed, because in most recent timeframes here on the right side of the graph, we're not seeing that. 81% of the time, we grew the portfolio. So this particular graph I find really compelling because it allows me, as I look at it, to say, okay, well, obviously that one right there, I wish I could get that 25-year sequence of returns. And I probably won't because it's so anomalous. But I'm going to get something average, hopefully among all these blue bars. And what was that average? Right here. My average portfolio balance at age 98 was 1.56 million. And I started with 1 million. That is encouraging. And what was my lowest balance? 613 right here. What was my highest balance? Just over 4 million. Wow. The longer I have both built and worked with this spreadsheet tool, the more convinced I am that the success of a retirement portfolio has more to do with my behavior, my patience, my persistence, my endurance, than it does anything else. And Fidelity can't give you that. T. Rowe Price can't give you that. Vanguard can't give you that. You have to give you that ability to hang in there and glean what we know from history, that if we stay with it, it will work out okay. But that takes courage. So this tool has given me more courage, interestingly. Okay, that's probably where I need to cut off, but we can handle questions now, we can handle a little bit later, whatever's best.
Excellent. Thank you so much, Craig. So before we move into some Q&A, we got some questions that are coming in about how to take advantage of our special discount, and then also how to access the RPA, or the Retirement Portfolio Analyzer, that Craig just presented on. So first off, I wanted to say, AAII members can get the RPA for just $100, regularly priced $150 online. So giving everyone a $50 discount just for attending today's presentation. We've attached Craig's order form in the handout section of your GoToWebinar control panel that you can use to purchase RPA. And then please email Craig at AAII.com. I put that in the chat for easy copy paste with your completed form. And then Craig will get you set up via email and provide some onboarding tools as well as the tool itself. And then if you have any questions, feel free to email Craig at AAII.com. And then you will also receive a copy of the order form via email later this week, early next. And then stay tuned, because even after the Q&A, we have still plenty to cover. So after Craig's Q&A, Cynthia will present and take some questions as well. And then plus we have a special offer for AAII Retirement Investing that you won't want to miss. So without further ado, don't want to take up too much time. Let's jump into some Q&A from the crowd for Craig.
Sure. Craig, great presentation, by the way. One of the questions I saw coming through quite regularly had to deal with different types of accounts. So Roth IRAs are non-qualified accounts, taxable accounts in more layman's terms. How does RPA handle that, or what suggestions you have to people in terms of withdrawals when they do have a mixture of accounts in terms of tax status?
Yeah, great question. So there's a couple of options. One is you can just leave things as they are, where this retirement portfolio account balance represents your entire portfolio. And let's say that conveniently 50% of it is non-taxable, which would be amazing if you could get that much stuffed into a Roth IRA. But let's say that 25% of it is non-taxable. Okay, so 75% is. One option is in the budget tab, as you are looking at your overall retirement income, would be to come to this column right here, which asks you the percentage of monthly income that is taxable. Well, if you know that of that monthly withdrawal, 25% of it is coming from a tax exempt environment, then you have to correlate that with what percentage is the withdrawal of your total income. You could go 75% is taxable. That's one option. Okay, that might be a little cumbersome because you're mixing annuity income and other income and Social Security and so forth, and it gets a little bit wire wrapped all together. So what I would actually suggest is that you do two different runs. This, evaluate or informing the spreadsheet what percent of the withdrawals or the monthly income is taxable. That's a pretty straightforward way if your situation allows that approach. Otherwise, you go back here and say, okay, I've got, of my $1 million, I have 250,000 that is not taxable. So I'm just going to isolate that. It's going to be the same portfolio, or it could be a different portfolio. It can be specific, and that's one of the advantages of slicing and dicing and using the analyzer to do two separate analyses, is that if you have a different allocation for your tax exempt stuff, then let's say it's just a very basic 60-40, and it's not likely going to be RMD, so you just decide, I'll do a 5%, okay? Then you would come to the budget tab, and in this case, you can leave all of your other income in there, just leave that all there, because that adds to, and then the amount that's, well, actually, what I would suggest you do is take all that out, so you're isolating only the income being withdrawn from the portfolio, and that is not taxable, and you just run that down, and then you get those results. Come back to the 4 asset tab, you get those results. That's an average annual withdrawal of 21,000. The average ending balance of that is 607. That's one separate analysis, and you would print that out right here. Yeah, and you can, in that yellow cell, you'd say this is the tax-free portion of portfolio, and there it is. That's the metrics for that. Then you would go back, say, okay, I've got 750,000. That's the other portion. That's a 25, 25, 25, 25. That's actually going to be governed by RMD. I go back to the budget. And in this one, I include my other sources of income because those are going to be taxable in all likelihood. Let's just put 1,000 there and 2,000 there. Just run those down. That's going to be taxable at 100%. Get all those metrics put in. Come back, go to the 4 asset print. This is the taxable portion of the portfolio. You print that out with those associated metrics, and then you just lay those side by side. And that is probably the most straightforward way to think about it, because it gives you control over different asset allocations for different portions of your portfolio, in addition to their different tax status.
Great, thanks. Another question we had, Craig, how to deal with allocation. Does the software handle international stocks or other assets than what you're showing right now on your screen?
Yeah, I wish this tab could, but we're going back to 1926, and we don't have any data going back to 1926 on international stocks. But if you go to the 7 asset tab right over here, let me get that a little bit larger so you can see it more easily. In the 7 asset tab, it's the same logic, but now we have 31 retirement periods, rolling 25-year periods, but we're starting in 1970. So if we start in 1970, then you have access to more asset classes. You got large stock, small stock, non-US stock. There it is right there. This has a 10% allocation to international stock. bonds, cash, real estate, and commodities. So you've got a more diversified array of asset classes, but a reduced number of rolling returns. That's just kind of the trade-off of not having the actual historical data going back to 1926.
Great. And we also got questions about ages and how that plays a role. One of the questions we saw come in was someone say, what if you're later in life? We also had someone ask if you're, if you're still working and you're trying to use this. Or also we had people ask if you're a married couple, and I'm sure this probably applies to several people where the spouses are different ages.
Yeah, and in the budget tab, you can handle the different ages. So if the spouse, say, is 3 years younger, they'll start in year 3. You just type in where it says year that retirement benefits begin. And so if they're 5 years younger, you're in year 5. And so you've got the one spouse who's starting now with their Social Security, and one spouse starting in 5 years down the road. And then you can adjust the individual annuity amounts or other retirement income specific to each individual, and then just combine those numbers in each cell. Remember, anything in bright yellow is what you control. So you have a lot of control in a spreadsheet environment to be very specific year by year. As far as starting age, let's say you're currently 60, but you intend to start withdrawals at 73. So as soon as I typed in 60, you saw this pink information pop up, and it's telling you your withdrawals will begin in 13 years, based on what you told me. In 13 years, your estimated balance will be 1.9 million, based on these allocations. If I go to 100% cash, well, it's going to be 1.0, just basically 1 million. So this estimated balance is a function of everything you've entered as pertaining to the portfolio allocation. So then what you would do, you would say, okay, cool. So now I would enter, just call it 1.9 million. And I'll set that to 73 because that's now my current age, because 13 years has gone by. And then on you go. So that's a little trick that allows you to do some basically future value planning of your portfolio's current balance. Now, if you're currently 80, that's fine. And you're using RMD, well, that's going to go grab the age appropriate RMD, which is 4.95. So your first year withdrawal will be 4.95% because that's what the current RMD table mandates. If you're currently 85 and your RMD is governing, now your current RMD is 6.25. So that's all automatically done for you based on your age. And obviously, as we age, the RMD percentage starts to really become a pretty high percentage. But did the portfolio fail? So here you are. Let's go back to $1 million is the starting balance. You have a 50-50 portfolio. Did the portfolio die? Nope. 100% success rate. Did it grow? No, it didn't grow because you're into those heavy withdrawal rates mandated by the RMD. So even though your portfolio didn't grow, it never died. And that's a really significant reality. But again, you're looking at 85 plus 25, which is 110. So in all likelihood, we're not going to be around to worry about the ending portion of this graph right here at the age of 110.
Great. Just one last question before we get to Cindy. A couple questions. People are asking about updates and what platforms the spreadsheet runs on.
Yeah, very good. I use a PC, so I know it runs on a PC. I have many people that have purchased the RPA that use a Mac, and it works fine on the Mac. And it also works with LibreOffice. And you do have to download some fonts, and I can help you with that. I don't know, that's just the weirdest thing to me. You have to download fonts for it to work correctly on Libre. but I've gone through that scenario. Those who purchase the RPA have access to updates that I automatically send for 12 months. So you buy the RPA, I've already issued 2 updates so far this year. And by this year, I mean on January 1st. And January 1st, each January is a big update because I add 1 more year of data for everything. But I also add features. So for 12 months, you just automatically get those updates. And then the renewal is optional. If you decide to renew, it's $100. If you decide not to, that's fine. If you decide to renew every other year, that's fine. There's no multi-year commitment, is all I'm trying to say.
Great. Thanks, Craig. I appreciate it. If we have some time afterwards, we'll come back to Craig with more questions. I know he also gave you his email as well, so you can certainly reach out to him. But I know Cindy's been patiently waiting, and she's got some good insights into retirement investing. So Cindy, I'll let you take it away.
Okay. So Jenna and Charles, my eyes and ears, can you see my retirement investing presentation screen?
I can.
Awesome, thank you. Welcome everyone, thank you for joining. I'm Cynthia McLaughlin. I'm the lead editor for Retirement Investing, and I wanted to spend a little bit of time on the website today, but first give you some background information about the product. So what we did when we launched Retirement Investing back in October of 2023 is we really set it up to solve your retirement challenges. So we're creating a specialized online resource, and it's going to serve investors at all phases of their retirement journey. So we have 3 basic phases. We have the accumulation phase that Craig demonstrated, where you're building your portfolio. Then we have the preparing or transitioning into retirement phase. And then after you go through that, you will be living in retirement and kind of withdrawing from that portfolio. So the objective is maybe not to be in focusing on just one phase at a time, but looking at everything holistically and recognizing that you can be in multiple phases at the same time. And we are targeting setting up the information in one actionable objective and great space where everybody can access it. And this service has been set up to complement our well-respected AAII journal and our other AAII tools and products. So these are, again, the 3 life phases. The content is labeled accordingly on the website, and it's set up so that you don't have to engage with something that isn't of interest to you, but it's set up to help you easily find the things you will find most helpful. So this is the home screen of the Retirement Investing website, and I am going to go over to that website. Okay, Jenna and Charles, can you see the Retirement Investing website?
I can.
You cannot?
I can see it.
Oh, you can. Okay,
Yes,
great.
yes.
Great, thank you. Okay, so the way the content is set up, we have things broken into the weekly insights and a monthly newsletter feature. The weekly insights and the monthly newsletter feature, just to talk about the cadence a little bit, these go out right now on Tuesday. So every Tuesday you will have something topical and hopefully helpful to you delivered to your inbox. And over here on the right-hand side of the screen, we have the life phases with accumulation, transitioning, and retired. So I'm thinking we might have a lot of retired people in the audience today. Just gonna log in real quickly. Sorry about that. Okay. Oh, there we are. So this is our archive for the retired investor. And right now, I saw a question in the chat where a person was asking about doing a conversion from the traditional IRA to the Roth IRA. Another way to find content, if you I'm going to go back to the weekly insights, you could click on IRAs and you will find all of the content related to IRAs. So this week we had the article on making the most of your IRA conversion. The week or the monthly newsletters are set up the very same way. We had an article last month about Social Security timing and how when you're planning to take your Social Security, how that choice shapes your retirement. So you would click on Social Security if you're interested in looking at all of the articles on Social Security. And we also have news. Just trying to keep everybody up to date on the news that is going on. This week we had a little news snippet where we pulled in some information from the Tax Foundation on property taxes. A lot of our members have indicated that they're very interested in a deeper dive on tax issues. And then we have a how-to section for anybody who is looking for information on special reports or just navigational tips. And I would say that Craig's tool is a great tool for all retirement phases, and I would even recommend somebody who is more in that transitioning phase but still accumulating to start using that tool just to get more familiar with working with these types of issues. I saw a comment from somebody in the chat where they said, retirement's a lot of work. Yes, it can be. And that's why we're here to help you. And we have the retirement investing service to bring everything together. Another feature that I want to point out, we have a really good community of very engaged subscribers. So with some of our articles, we will get a lot of comments, and I'm very appreciative of everybody's comments. So if you're a current subscriber and you're commenting on articles, that is fantastic. And I really like to get a lot of different ideas from my subscribers. But I think it's helpful for everybody to be able to kind of understand what other subscribers their questions and concerns. And that is all I had. So.
Excellent. Thank you so much, Cindy. So before we move into some Q&A with Cynthia, I want to share how webinar attendees can purchase AAII Retirement Investing if you haven't already. Like Cindy mentioned, the RPA and AAII Retirement Investing are very complementary. If you're interested in purchasing AAII Retirement Investing, you can visit invest.aai.com/retirement-investing-FP, and I'll put that in the chat so that you can easily copy and paste, and then we'll also send that link out via email, and I think it's also listed in Cynthia's handouts presentation, so you can just copy and paste very easily. But you can visit to purchase AI Retirement Investing at a discount. So regularly priced $99 per year, we're offering investors a chance to get a 1-year subscription at just $74. Plus you get that 90-day money back guarantee, so you can take a look, explore the content, and everything AI Retirement Investing has to offer before you commit. But I don't want to take up too much time because I know we're already going a little bit over, so I appreciate everyone sticking with us. We have a pretty lengthy presentation, but I know we had a lot of great resources and valuable insights that both Craig and Cynthia shared today. So without further ado, let's go into some Q&A with Cindy.
Sure, Cindy, real quick. So retirement, is that part of AI Platinum?
It is part of AAII Platinum. Yeah, try to say that. It's almost like a tongue twister, AAII Platinum.
And I've got a question, I guess, for you and Craig. Someone asked about the SMILE pattern of retirement planning, and basically meaning that you spend a lot early retirement, you kind of your spending drops down middle retirement, and then accelerates at the end. Suggestions on how to plan for that or how to take that into consideration?
I would say that you need to use a model, maybe to map out some of the scenarios that you're going to encounter. And I do think that also from the perspective of when you retire, it's not just all about the money. You need to figure out what you're going to be doing each day and how you're going to live your life, because from my understanding, it's very different just to shut off work and have a much more leisure time than one ever dreams of having during the workday.
Yeah, I can weigh in on that. You actually can enter that sort of curvilinear. I can show you if you want real quick. It's kind of cool. Okay, are you seeing mine?
Not yet.
Okay.
Craig, let me give you presenter.
Okay.
You should be able to now.
Okay, it's kind of a fun feature. So what you would do is you would enter the word custom. When you do that, all these cells down here open up. Do you want to be dollar withdrawals or percentage withdrawals? So if I type a 1, then I can type in what percentage I want. So I'm going to do 7%, 6, 6, 6, 6, 6, 5, 5, 5, 5, 5, 4, 4. You get the idea. And then it could ramp back up. 5, 5, 5, 6, 6, 6, 7, 7, 7, 7, or whatever the. And you can see what happens. These are the withdrawals, and it's kind of a funky, curves. But it allows you to anticipate a larger withdrawal in the early years, kind of going down a little bit, and then possibly larger with healthcare expenses. So it's kind of a U-shaped sort of function. And if you want to do it based on dollars, you just type a 2, then you can enter whatever dollar withdrawal you want. So it's a handy feature to model that exact question.
Great, Craig. And one other question for you, Craig. I know we're running over. A couple of people asked, because I know you used the 25-year periods in terms of showing scenarios. Can that be adjusted?
No, no. But what ultimately happens is that the person runs the analysis. They're currently, let's say, 70. Let's just make it easy. It's a 73. They're just starting the RMD. And with the information they've entered, they see that they have about a $3 million balance 25 years from now, which means, well, you didn't run out of money on average. And in fact, you never did. Your success rate was 100%. In all likelihood, 3 or 4 or 5 years down the road, you're going to run the analysis again. So you're going to be now 78. And now here's your balance. And if it's RMD, then of course you're deeper into the RMD withdrawal rates. But my point is, most people don't just use this tool once. They use it progressively over time. So they keep pushing out that 25-year future window. And so specifically to your question, no, it can't be adjusted. The 25-year rolls those are locked in, but you essentially can roll them by using the tool iteratively over time.
Great. I think that's pretty much most of the questions, Cindy. I'll tell you, we just did get a request in for more information about dealing with Medicare. So article suggestion for you. Cynthia and I just had a great conversation with Howard Gleckman regarding long-term care. Part of that is in this month's AAII Journal, but Cindy, I believe we're going to have follow-ups to that in retirement investing as well, correct?
Yes, that is correct. And to Charles' point, I just wanted to emphasize that we do feature experts, and I do bring in experts for interviews and to help with providing content where it's a more complex topic or something that is just a little bit out of our wheelhouse, just to give subscribers that information that they need.
Great, and we did have one question regarding what's included in AAII Platinum. That includes all our premium newsletters, our retirement investing, dividend investing, growth investing, stock superstars. Obviously, our model shadow stock portfolio is included in membership and Platinum. With Platinum, you also have access to our A+ investing service, which provides you more advanced data and more advanced tools. The RPA is separate of that. Craig, is Excel needed for RPA? That was one question we did see come through.
Yeah, it runs off the Excel engine, and that's either on the PC or the Mac.
Great. Well, thank you so much, Cindy. Thank you so much, Craig. We both enjoyed it. Jenna, I will hand it over to you.
Jenna.
Yes, thank you so much. Well, we're about to move into our conclusion, where I'll kind of, reiterate our special discounts that we're offering attendees today. I mentioned a lot, so I want to make sure I get everything, clear. And then as well as information about the recording, we always get questions throughout the broadcast when people join in, asking about when they'll be able to access the recording and other resources. And then, but before we do, I do want to ask Craig, do you have any final thoughts you want to leave the audience with?
Wow, now's my chance, huh?
It's loaded.
Well, yeah, I mean, the best advice I ever heard was from Ron Mullenkamp, manager of the Mullenkamp Fund. He said, quote, "If you want to take volatility out of your portfolio, check it less often."
I like that. That's great advice. And Cynthia, do you have any final comments you want to share with the audience as well?
I do. I think Craig's comments early on about being patient and persistent are spot on. And I think that as we're kind of entering an economic shift here, that's really important, just to keep a cool head and take a deep breath and not check your balance every day.
I couldn't agree more.
Yeah, play with your grandkids. Don't check your balance.
Exactly. Exactly.
Great advice.
And first off, a big thank you to Craig and Cynthia for guiding us through how to, master retirement planning with, like we said, two very complementary resources: the Retirement Portfolio Analyzer, as we referred it to as RPA, and then also AI Retirement Investing. And then if you have any questions, we threw a lot at you today. We appreciate you spending so much time with us. We usually only run an hour, but we run a little bit longer just because we had so many valuable insights and things to share with everyone. But if you have any questions about AI retirement investing, if you want to get started with it, or anything else as far as AAII related, feel free to email us at members@aaii.com, or you can always give us a call at 312-676-4307, and that's Monday through Friday, 8:30 a.m. to 5 p.m. Central Time. Our member services team is happy to assist you in every way that they can. And then also, we are offering AI members or anyone associated with AAI to purchase RPA at a $50 discount. So the RPA tool costs $100 per year for those associated with AAII, as long as you can use the order form provided. And then if you'd like to purchase RPA, please complete the attached handout and then email Craig@aaii.com. And then all questions about RPA should be directed to Craig via email at Craig@aaii.com, like I said. And then, as I mentioned earlier, a copy of the order form will be sent via email to all who attended today. And then our second special promo today allows attendees to get a 1-year subscription to AAII Retirement Investing for just $74. So please visit invest.aaii.com/retirement-investing-FP, and I'll put that in the chat one last time. But like I said, it's linked pretty much in every handout that we have, and then also the email that will be sent to you directly. And then lastly, this presentation was recorded and a replay will be available at aaii.com/webinars early next week. And then webinar attendees will receive an email with a link in the next few days, early next week. So please be patient with us. And then you'll also receive a copy of all the presentation slides, the handouts, a handy resource document that we put any kind of links that we think could be helpful, and anything that we discussed in the presentation today. And then with that, we wish all of you viewing good health, good fortune, and a great rest of your day. Thank you so much and take care.
Bye. Thank you. Happy investing.